Hey, everybody, to your Uncle Seth and it's Seth and Uncle Paul. You know that. Everybody out there, you all know that. Welcome in. Michael's got purchased yesterday. I was frothing at the mouth. I'm a big fan of Michael's. Paul is too. I'm not a huge fan, but I mean, you and your home goods and your little trinkets. I'm kidding. I'm making all this up.
I've been to Michael's twice in my life.
I'm making all this up.
I go to Hobby Lobby.
For your little crafts? Yeah, you do little...
for my framing and stuff like that. And I don't really go. I go when I'm accompanying somebody who's doing something for me.
Yeah, Paul does little crafts at home. But anyway, Michael's got purchased. And at first I was like, wow, why did it get purchased? What's going on? And who purchased them? You know, we had a similar situation, Paul, a week before with Lucid and CCIV, where everyone was expecting CCIV to skyrocket because of this merger. It, of course, didn't, which we told you so. But in general, here's another purchase. I want to get down to the nitty gritty of what's going on. Why would a company buy this? What's the financial health of Michael's? What's the financial health of Apollo Group, which is this enormous group? Paul, I had never heard of them, but you know all about this group.
I mean, I've heard of them many times, of course. They're, they're a huge private equity firm. I think it's something like $400 billion in assets, started 30 years ago. Private equity, guys, is not there's good and bad to everything, right? And in private equity, what their goal is to buy what they perceive to be undervalued companies. They tend to load them up on debt. I'm not saying that's going to happen here, but they tend to put a lot of debt on the companies, really increase their profit as much as possible, and either sell it off to somebody, take it public, or as they take on more debt, pay themselves out distributions. I know a few people in the local area who bought companies with private equity firms, and they brag about all the debt they take on. And I'm like, what are you guys gonna do with all this debt? They're like, pay ourselves distributions. And I don't like that, because at the end of the day, if the company goes under because of too much debt, they've already been paid back. It hurts jobs. Again, they're allowed to do whatever they want. There's still, I perceive to be a better way. I do believe, I'm of the mantra, where if you run a business well, you don't need, like all of our businesses upstairs, all of our operating businesses, zero debt.
You were very proud of this.
I'm very proud. When I say operating businesses, everything but the real estate. And even the real estate, the Mexico homes have no debt. I'm very big on, we're gonna focus on building a good company, a good way, and we'll get a good return on our money by doing it that way. We don't need debt to go magnify that return.
So if you like what Paul's saying, stick around for this video. We're gonna look at Michael's. Why were they bought? What are their what's the financial health of Michael's? And why did Apollo Group buy them? What do they see in this company of the many companies they had? Apollo Group is a New York company founded in 1990, Paul. They have 1,700 employees. And you told me-
Oh, that's it?
Yeah, they're a global alternative investment manager firm, a lot of words, but their subsidiaries, Paul, I was so intrigued. Diamond Resorts, ADT Security, McGraw-Hill, which makes the books out of Columbus, Redbox, Qdoba.
Phoenix University
of Phoenix, Coinstar.
Qdoba is part of there?
Yeah, Great Wolf Lodge, which, Paul loves going by himself and frolicking around the waterworks with the children.
I only go with my van that has blacked out windows and says free candy inside.
And that's really just for the moms.
Well, you really got Don to laugh on that one.
Oh, that was great. All right. So anyway, we're going to look at Apollo Group. What the hell is going on? Why they bought this? Paul, give me your thoughts on a transaction like this, because as a normal person, I just see it. I would expect with the news of some stock rising.
It did.
Talk about it.
I mean, well, let's look at what the stock did. Yeah, the stock was up a lot yesterday. I think it was up 20%. But here's the amazing thing. Michael's was down at $1.36, I think, a year ago during the crash. $1.36.
That was their stock price.
For sure. Now it's currently today at $21.85. And it was up
amazing
20% in the last few days. So on this news, I don't know what they're buying. I didn't look at the exact detail. What's Apollo paying for these shares?
Well, I heard they're paying $22 a share for all the shares outstanding, and I think it's around $5 billion, which you always lead with when we do our 8-pillar analysis on companies. You say, if you want to buy the company right now, you can buy all the shares at X price.
And that's what they're doing.
That's exactly what they're doing.
Years ago, so when I looked at Michael's, it wasn't screaming to me in terms of PE. So years ago, Dell Computer was a publicly traded company. It was selling for 8 or 9 times profit. So Michael Dell partnered with, I think, there's another private equity firm, and they bought the shares out saying, listen, this company's worth way more than 9 times earnings. We'll just go buy it ourselves, run it, and focus on growth. That's a private equity transaction I like a lot more. And the reason being is it was a founder saying, listen, I think this stock is so undervalued, I want to go return this company around. But the issue is, the reason I do like private equity though is, I like the fact that they're not going to focus on short-term results as much. The issue with publicly traded companies in the United States is it's all about making money tomorrow. Okay, the quarter ended. How's this quarter going to be? It's very difficult to find CEOs like Warren Buffett and other long-term thinkers who are going to sit there and say, I don't care what we do quarter to quarter. What I care about is, am I allocating capital today to get a high return on my investment for 5 years from now? That's a very tough thing to think about because this world rewards, this corporate America rewards CEOs on stock price. And so they're incentivized to do anything possible to make the stock price look better. That's the reason I do like taking companies private. You can then refocus and say, how are we going to focus on growth and not worrying about hitting our numbers every single quarter? So I kind of like it for that reason. I don't know what Apollo does, how they look at debt, how they handle debt, etc. Are they going to load up Michaels on debt and spit off a bunch of cash? I don't know how it works, but how they're going to do it. Have they said anything, Seth?
Not that I see so far. I mean, frankly, as a normal person, I don't quite understand when a publicly traded company gets bought and then goes private. Will the stock price go away, or
yeah, the stock will go away.
Stock will just go away.
The stock will go away because they're just doing a buyout. They're buying everybody's shares out. Stock goes away, and at some point in the future, they'll either take it public again or Apollo Management. I don't know. Like Apollo Management's publicly traded too.
Yeah.
And I don't know if their publicly traded entity part is the fee management business or if it's all the companies combined. I don't know. I have to do a lot more digging on that one. I just did a very high level thing here, but guys, just like everything in life, nothing is awesome and nothing's always awesome, nothing's always bad. There's usually some sort of in between. Private equity can be great. It has gotten a negative connotation, in my opinion, because of the fact that they tend to lever up and put on a lot of debt on the companies. And at the end of the day, and by the way, you know who did this a lot? Our good friend Mitt Romney. He was part of Bain Capital. They would load companies up with debt, try to turn them around and sell them off. And sometimes it didn't work. A lot of debt can make a good business very bad. Because when you have a downturn, which eventually will happen, when you have a downturn, if you can't support the debt, all of a sudden you have lien holders trying to shut down the business or trying to take away assets from you. And that's just not good for business. And then they start cutting costs. Easiest costs to cut are marketing costs and employees. And you sit there and say, well, you need marketing to grow and all that stuff. So I don't know if, my views have changed a lot in the last 20 years about how I view this stuff. But I just really do believe the mantra of if you build a good business and don't put a lot of debt on it, you can still get a great return on your money. That's it.
Do you want to take a look at Apollo Group and what they're doing?
Yeah, I mean, in terms of what they're doing, how you mean?
8 pillars.
8 pillars. Yes, let's look at that. APG, right? No.
APO.
APO.
What you're looking at, guys, this is the Everything Money software. This is what you're getting if you're a Patreon. Our patrons are frothing at the mouth to get a hold of this on April 15th. We're beta testing it now. Paul will put up a comparison slide later in this episode showing what you're getting as a patron versus what you're paying to other companies, maybe for this type of data. And so stay tuned for that. But right now, we're looking to run our 8-pair analysis on Apollo Group Management out of New York.
And they just went public about 10 years ago. Mm-hmm. So we have a 10-year chart here. Market cap, Uncle Seth.
What is the market cap?
$11.5 billion. $2 billion in revenue. So I'm assuming that's the management side of the business. They have no PE because they lost money in the last 12 months. Mm-hmm. So no PE. Profit margin's obviously negative for that reason. So we have 2 X's so far to start. Okay?
They do have a dividend, Paul?
What was that?
Their dividend is high?
They do have a high dividend. Now, look at this. Their dividend of $523 million, the last year they've had $1.7 billion in free cash flow. So they have plenty of cash. Even though they had a net income loss, they had a lot of free cash flow. So part of your job as an investor is to understand, why did the net income and free cash flow differ so much over the last year? Because over long periods of time, your free cash flow and your net income should roughly be pretty similar. If you compare 10 years and 10 years of net income and free cash flow, they should be very similar, or I would start questioning what's going on the books.
Pillar number 3 is revenue growth over the past 5 years. Obviously, we want them to be growing.
So in the last 5 years, let's look at this. We have $1.48 billion to 1.97. So it is a check. Check, please. But if you look at this revenue all across the board, Seth, 1.48, 2.6, 2.1, 1.9, 1.97. Look at the previous 5 years, 1.5, 4.1, 2.08, 1.12. I mean, it's all over the board. So already I go, I don't really like that very much with the losses lately, so.
Profit growth is pillar number 4, Paul. Profit growth, baby.
Definite X, 242 down to a loss.
Oh boy.
So that's an X. Now, I'm sure the loss had something to do with COVID, but I think we only have one check so far, and it's barely a check.
Yep. Let's do shares outstanding, which is pillar number 5.
All right, X, 731 to 904.
They're selling off, huh?
Yeah, this is a lot of X's here, guys. And I encourage everybody to go read Warren Buffett's annual letter because it talks about buying back shares when I've talked about it. It's important if the shares are undervalued that companies buy back their shares. It's not just a buyback shares and we're all happy. Make sure it's being done in the right circumstances.
Yeah, our video on Berkshire Hathaway and Warren Buffett came out just yesterday. So if you're watching this in the future, go ahead and search it up. It totally slayed, and we got a lot of positive feedback about that, Paul. Pillar number 6 is current assets over current liabilities for the company, which is what company is Apollo Global?
4.38 billion.
Okay.
To 1.94. So we have a check there.
Great.
Yeah. What are you laughing about on this?
Well, a lot of YouTubers record their shows, so they don't have funny things like that. Like where I'm just like, what company are we doing again?
Why is the okay? We have okay.
So pillar number 6 is an X, Paul. That's sad to hear. Oh no,
Yep.
Darn. Free cash flow is pillar number 7. We want their cash from operations better than their capital expenditures, Paul.
Okay, so their free cash flow in the last 4 quarters was 1.69 billion. It looks like it's up. There is a little glitch here on the Everything Money since we're beta testing it. I show the 4 quarter. It's not showing the previous years, but that's okay. So far, it's pretty. Oh, interesting. It's actually not that bad here. Mm-hmm. They have definite cash flow. Okay, but again, look. So we have free cash flow here, guys. The one thing I do for you guys is free cash flow is not actually a line in the investing section, but to make it easy, I put it there.
You're not going to find this on Yahoo Finance.
You're not.
Or Y Charts.
It's funny. Somebody wrote a comment on YouTube saying, I get so confused doing my 8 pillars myself. When is the software coming out? And I was like, April 15th, don't you worry. They're like, thank you. I mean, it was, because it's great. That's why I'm trying to make it as easy as possible for you, because guess what, guys? I'm lazy. I want it as easy as possible for me too. I know what I want to look for. Why do I need to sit there and do all these calculations to make myself feel smarter? Just give me the information. It's just done. Here's the information. Move on. So what? It's true though, Seth, is it not?
I mean, you remember in Dumb and Dumber when his foot's on fire and he's like, just give me the number.
Just give me the number. That's exactly it. Just give me the number. That's a good one. I wish we could curse.
Yeah.
So either way, we have 576 to $1.4 billion. Check mark there. Wonderful, excellent, perfect. So we have check mark there.
So pillar number 7 is a check mark. Their free cash flow is growing. What about the 3 middle numbers, Paul?
The 3 middle numbers, you're going to ask me the hard thing.
Yeah, to get the free cash flow.
799.52, such as 799, 851, 593.
So the average free cash flow over the past 5 years is 0.85. So $850 million.
Okay, and we multiply by 20, that'd be 16 billion.
Yeah,
and the market cap is 11.5 billion.
Wait a minute now.
Yeah, so it is a check here. And if you look at the 8 pillars tab here, guys, the great news about the 8 pillars is, look at this. Our website will give this all to you so you can be lazy like me, because we all love being lazy. We deny it, but we really want to be lazy.
Now they have assets over liabilities as a check. We had it as an X, Paul. So
we do not have it as an X. We have it as a check.
Oh, check for assets per. I read you wrong. Perfect. We are checks. So their free cash flow average. Their free cash flow average is $850 million.
850 million times 20 is $17 billion.
That's correct. So
they're currently selling for 11 billion.
So you want the market cap
1.5.
So pillar number 8 gives us basically our desired market cap, and it's
from a 500-foot view.
Go on, and it's currently much lower. What are your thoughts?
And the other thing is, last year's free cash flow was 1.7 billion. So this might be one of those situations where you need to understand here, why is the net income and the free cash flow so different? There could be a million reasons why. I don't know what they are. If this might be a business where you need to focus fully on the free cash flow statement. There might be a lot of depreciation expense in this company. But right now, oh man, you know what's funny? Up until that free cash flow number, I was a no.
Yeah.
I'm looking further.
Look at that. Look at that. Yeah, that's incredible.
Is it selling for freaking 5 times?
Free cash.
No, 6 times last year's free cash flow, and
last year
15, not even 14 times the previous 5 years average free cash flow.
Yeah, and they got slayed last year. With you think about a lot of these companies that might not be around. I mean, school books, places where you go out to eat, Great Wolf Lodge, all those lodges, those swimming places, those have been shut down for a long time. I mean,
look at their stock. Their stock is up a lot in the last. I mean, it's It got as low as $23.
So what's your final take on Apollo Group?
I think do more research on this one. I think this is a very interesting play. Go find out. I would worry about the debt. They have $14.5 billion of debt. And that's a lot, it seems. And go understand how they make their money.
Well, tell me this. Going back to the beginning of the episode is why do you think they bought Michaels and how will they profit from it?
They'll profit from Michaels doing one of the three things I said. Either loading up on debt and paying themselves a dividend, going public, or selling it off.
Okay.
That's how they make money.
If you like what you see here and you want to be a patron, if you've never joined a patron, you might be scared. All you do is click on the link below. It's a cool little place. People ask me, what is it? Well, it's a community that you can join where you partner with us, myself, our team from Everything Money. You get access in the top tiers to Uncle Paul and Trader Mo. If you're into day trading, you can follow Trader Mo in the middle tier and he'll walk you through all of the trades they make. If you're in the top tier, you see everything that is Paul Gabriel, his trades, what he's doing, the amount of money he's making on options and what he's buying, our full portfolios. You get fireside exclusive chats with us, the whole kit and caboodle, and you get access to this wonderful software as well as perhaps a chance of winning 2 Teslas that we're giving away this year, 2 amazing brand new Model 3 Teslas. We're having a promo video coming out very soon. So what Uncle Paul's dying to show you is this comparison chart before we wrap up the video. Go ahead, Paul.
So guys, I'm big on comparison charts. I look at them whenever I buy something. Show me how you're different than somebody else. Show me your different plans, why they're different. I basically went on here and said, okay, here's what we offer on Everything Money. Check marks for everything. Current price, $14. Guys, this used to be $8. And every time it fills up a new level, I increase the price.
We're talking about 2 months ago, it was $8.
Yes, 2 months ago it was $8. This is going to $50 at some point, if not higher. This is our biggest competitors. Why charge Trading Economics, Yahoo Finance? I do subscribe to this at the higher level of $500 a month. Their cheapest plans are $199, $199, and $35. Guys, not even close. I am providing such immense value here, and the reason I can do that is I was building this software for myself to begin with without charging anybody. So I don't need to go make a ton of money off it. I can go charge low amounts of money, but I want you to value it. This is crazy to not do this. You get 8 pillars, 10 years of financial data. At some point, stock value calculator, real estate calculator, house flip calculator, momentum trading, stock screeners, retirement calculator, Discord community. This is huge, and you can cancel at any time. Why charge? You have to pay for the full year. Guys, this is crazy if you don't do it. I really love it. This is only going up from here. We only have 70 some spots remaining in the $14 level. So please, don't be penny wise and dollar dumb. Go do it. Trust me when I say, like all our page, I get messages every single day. Seth gets them, Don gets them. Guys, they love it. Everybody's like, this is the best thing I've ever done. We've had people literally say, this has changed my life.
I agree. I hear it all the time too. And so, yeah, if you're finally ready to get serious about investing and need some guidance, we're here for you. Make sure, as always, you tickle the thumbs up. We love that little tickle, that little thumbs up. And yeah, that's our take on Apollo Group and Michaels. Stay with us, subscribe. We love you guys. Appreciate it.